3, 2, 1. Here we are, back again.
Okay.
Not in the studio,
Back again.
but we're
Right.
making it work.
No,
All right,
we're
man.
definitely making it work.
Yeah. How's it going, Jerry? What do you got for us this week?
It is good. I'm back in Virginia. It was a long ride back. Got almost sucked into the vortex in New York, but made it through and back down here in Virginia at my place. And so we're still testing out the ability to kind of do it from different locations. So me and Conan are at our respective places.
Yeah, we'll get it figured out.
It looks like it's working. So let me share my screen and we will get on to it. Okay. Weekly update show, 18 July 2021. It was a rough week for the stock funds, no doubt about it. C fund was down almost 1%. S fund was a big loser, down over 4%. I fund down about 1.5%. The F fund was the only positive. Of course, the G fund is always positive a little bit, but F fund was the only real positive at up 0.19%.
If that's the only positive we got to look forward to.
I mean, the charts are better, but on a weekly basis, that's kind of how we ended up.
Yeah.
So we're going to take a look at what happened this week, and then we're going to talk about impulse waves versus corrective waves. I think it's going to come into play in a very short-term basis in terms of the C fund, but we're going to get to that. Then the C fund, kind of longer-term Elliott wave projections. We're going to stay with the bonus chart of snow because the chart looks quite a bit different than it did last week. If you remember, last week was also, the bonus chart was also snow. And then we'll look at the 18-month weekly charts. Okay. If you didn't see the show last week, definitely go back and look at it because a lot of this is going to kind of continue from last week. But this was actually the first chart that we showed last week. It's the C fund. The whole chart is 1 month and each tick is 30 minutes. So this was last week's chart. We talked last week about how this whole thing was a big mess, as JC would say. As opposed to this really nice kind of channel right here for several weeks, right? For the second half of June, the first week or so of July just was one big sloppy correction. And so why do I say it was kind of a sloppy correction? You had one move down, you had a A, B, C move back to the top, you had a one move down, you had an A, B, C move back to the top. So if you're somewhat familiar with Elliott waves, you can kind of look at this and say, okay, if we're seeing a lot of ABC, right, or 1, 2, 3 patterns in the overall trend, it's corrective. It's not impulse. And we're going to get into what the difference is between corrective and impulse. But when you see the trend move in 5 legs or waves, you could use that word interchangeably. When you see the trend move in 5 waves, it's an impulse. And when it's moving in 3 or ABC, it's corrective. And ordinarily, not always, but ordinarily, the corrective pattern resolves in the direction of the previous trend, which in this case was up. So we had a trend that was up, we had an ABC that was down, and then we had a continuation of the previous trend.
And just to be clear, Jerry, when we're talking about correcting, that's really like a sideways move, right?
It can be sideways. In this case, it was, right? Pretty much I won't say it was down, right? It was A, B, C. So we finished lower than we started.
Okay.
But in the big scheme of things,
yeah, that's what I mean. Like when you kind of zoom out on a chart, right. I'm just trying to point that out to folks that might not be as familiar with like what correcting means, right? But that's generally
there's another kind of correcting or consolidating, right? If the market is correcting ordinarily, like this here is more of a correction because it had a much lower, a deeper correction. This is sideways. It would be considered more of a consolidation.
Okay.
Okay, so that was last week. So if we fast forward to this week, this is what we were looking at last week. At the end of the week, you remember we had we finished at highs. But this week, the market rolled over, and it didn't roll over in a ABC pattern, right? It rolled over in a 1, 2, 3, 4, 5. Hopefully you can kind of see what that looks like. You got 1, 2, 3, 4, and this is probably going to be a 1, 2, 3, 4, 5 to finish the 5 down here before we get some kind of move up here, which will probably be an ABC. So let me just continue, and we're going to get into that a little bit. Okay, impulse waves versus corrective waves. So come out of Wikipedia if you want to, or Investopedia rather, if you want to take a look at it a little bit deeper. But an impulse wave pattern is a technical trading term that describes a strong move in a stock or financial assets price coinciding with the main direction of the underlying trend. Okay, so if the underlying trend, if you're in an impulse move, whether it's up or down, the main trend is in that direction. Okay, it's frequently used in discussion of Elliott wave theory, a method for analyzing and predicting financial market price movements. Impulse waves can refer to uptrend movements or downtrend movements. So this is what the ideal uptrend impulse wave looks like. In the big scheme of things, you have a one leg here. Within that one leg, you have 1, 2, 3, 4, 5. Okay, so that's what makes this one move an impulse. If this one leg had played out as an ABC, you would have finished at the same place. You would have started here and finished here, but it would not be an impulse wave. If it's not an impulse wave, you're not going to get a correction and then a continuation in the trend. So the underlying, so if this is the big wave, for it to be an impulse wave, you got to have 1, 2, 3, 4, 5 within it. The corrective waves are ABC. That's your 2. And it goes along. This is kind of what it looks like sort of in real life. And the part that we want to focus on right now, if we are right here, this is the big if we're here, then we get an impulse wave 1, 2, 3, 4, 5 going down. Then we expect an ABC correction, meaning it's correcting this move. That's what that is. It's the ABC corrects the most recent move, right, in the impulse. So we had a 1, 2, 3, 4, 5, and then ABC. So on the ideal one here, this was if you were in an uptrend. This is sort of the ideal, this part of it is the ideal of what it would look like if you were in a downtrend. You still have the 1, 2, 3, 4, 5. It's just that 1, 2, 3, 4, 5 is going down. And the correction is ABC going up.
So is this what we think we're looking at? Are you getting ready to talk about that?
Yeah, right. So potentially, right, if we're here at a top, which obviously we are at a top, if it's this, then did we just have a 1, 2, 3, 4, and the 5 is almost complete? And then we would get an ABC. And then after that ABC, right, you get another 1, 2, 3, 4, 5 down to the C. And theoretically, the C here corresponds roughly to the low of the 4 from back here. That's ideally how it would look. So if that's the case, we get 1, 2, 3, 4, 5 here, one ABC here, and then some kind of move down here. And so this is all in terms of the time frame, 1 month, where each tick is 30 minutes. So in the bigger scheme of things, if we do get this, from right here, we got 1, 2, 3. We should get some kind of 4, 5 before this bottoms. That could happen in the first hour on Monday, literally. Then we get some kind of ABC, right? And then we get 1, 2, 3, 4, 5 down to here. If this low is below this low, now we have a potential problem, right? At least in this time frame. Because once we get below this low, the next low we're looking at is this one.
Yeah, that would be nasty.
So again, it wouldn't, right? Because we'll get to we'll draw back a little bit and look at the daily charts.
Yeah.
Actually, we're going to look at the weekly chart, so you'll see it. So down here we are, what, 41, somewhere below 4180 would be it would be a problem for sure. But we'll see what it looks like on the bigger chart and see in terms of days or weeks. But that just kind of gives you an idea. So the reason I put this up is because when I see a 1, 2, 3, 4, 5, it indicates it's an impulse, and it's an impulse wave going down. So obviously it's not what we want to see if we're in the stock funds. Okay. So C-Fund Elliott Wave projection chart. We put this up. I can't remember if it was last week's show or the newsletter or what, but we just zoomed from the 1 month where each tick is 30 minutes to an 18-month chart where each tick is 1 day. So here was the top from before COVID. Here was the bottom after COVID, which was a 34% drop. So it's a significant bottom. So if we count this bottom as the beginning of a new 5-leg higher, we got 1, 2, 3, 4, 5 for the 1. And we got ABC for the 2. So now we are in the middle of wave 3. So the question is, where does wave 3 end? And we talked about last week, there's a couple different ways to look at it. You can use the Fibonacci extensions as a projected target, which when we hit the 161.8% of this move, it was right here about 4,200. And we hit that, went sideways for a while, and then popped up from it. The next Fibonacci target is the 261.8. So keep that in mind for a second. So there's 3 cardinal rules of Elliott Wave. Only 3. All the rest of them are like guidelines. The 3 absolute cardinal rules: wave 2 cannot go below the beginning of wave 1. Okay. So the beginning of wave 1 for us was down here at the low after COVID. We had this 1, 2, 3, 4, 5 run up for wave 1. If wave 2 had gone 1, 2, 3 and finished down here below this low, then this would not be a 1. So that's the first rule. Wave 2 can't get below the beginning of wave 1. The second rule is wave 3, which is going to be this, cannot be the shortest impulse wave. Doesn't mean it has to be longer than wave 1. It just means it can't be the shortest. So if it's not longer than wave 1, that means wave 5 has to be shorter than wave 3, right? So if that's the case, it really limits our upside for wave 5. So right now, I'm looking at this and I'm saying, okay, we had some weakness this week. if that weakness turns into some kind of correction or consolidation or something like that, right? Then we would have the 1, ABC is 2, the 3 would be complete, and the 4 would be down here. So what does that mean? It means the 5 has to be shorter than wave 1, because right now wave 3 is about 1,200 points, 1,200 points long. So basically 3,200 to 4,400 is 1,200 points. That's wave 3 right now. Wave 1 was 2,200 to 3,600, which is 1,400 points. I think that math is right. Wave 1 right now is longer than wave 3 in terms of points, not in terms of time, but in terms of points. So that means wave 5 has to be shorter than wave 3. So that gives us about 1,200 points to play with on wave 5. So let's say wave 4 went sideways for a little bit and bottomed out at about 4,100. If wave 5 played out in 5 legs like that, and it was the same length, a little bit less or whatever than length than wave 1, if it went from 4,100 and added 1,200 points, we'd get to 5,300 up here, which is the Fibonacci target at 261.8. So I'm looking at that right now as the most likely long-term target. And all that is contingent on wave 3 completing more or less right now. And so for the next couple of months, we do wave 4, however that plays out. We get so this is relatively, it's a correction, but and in terms of percentages, it'll be significant in the short term, but in the long term, obviously it's relatively flat. And then we get a move to new highs. The projected new high would be somewhere around 5,300. So as far as crystal balls go, that's it. That's what I got.
We don't do in crystal balls.
No, it's the value of technical analysis is to have targets and then, fire and adjust basically. So right now our target, based on all this back here, all the Fibonacci counts and everything else back here, the target right now is roughly 5,300 up here, but it only gets there if we get a 4 and then a big 1, 2, 3, 4, 5 back up to it. So in the short term, I'm bearish, right? I think the market's coming down. In the long term, I'm bullish because I think eventually we're going to hit here, and this will be the top with the capital T. The top.
That rhymes with get out. Capital T.
Oh yeah, it should rhyme with get out. Because if this is 3, and we get some kind of ABC for 4, and then we get a 1, 2, 3, 4, 5 for 5. After that is
It's
ABC.
long way down.
Yeah, it's gonna be something like, yeah. So short term and long term, you got to be able to keep them both in your mind at the same time. That's why it's so hard to answer these questions. I'm about to retire. What should I do? If you're about to retire, and what should you do in the short run? I think the market's going to go sideways to down. It's just impossible to answer those questions. That's why I have such a hard time with being allocated for an extended period of time in any certain kind of allocation process that's going to stay there for a long time, like the L funds, for example. Okay. Bonus chart was snow last week. Here's what it looked like last week. We had a really good sort of flat head and shoulders bottom pattern with roughly 4 or 250 as a neckline, and we got a really good pop from it. So not only was it the head and shoulders bottoming pattern, but we also got support at the 50-day and then popped up off the 10-day right there on pretty big volume. So that's a great chart setup. Again, technical analysis is analysis. It's not math. So there's no guarantee. There's no right answer. 1 and 1 doesn't equal 2. So we use the analysis to make reallocation decisions, or in this case, decisions on whether or not we would want to buy it. So if you were going to buy snow in this case, if you're going to buy anything, you want to use a stop loss. And again, this is not TSP, but if I wanted to buy snow on the breakout, how would I know if the breakout was going to fail? If price rolled over and closed, you could pick either below the 10-day here or below the 50-day here. Certainly anywhere down here, the pattern is voided. And so when this setup occurs, the odds of it continuing higher are in your favor, but you just got to know when you're going to get out if the market does not continue higher. So what happened? Over the course of the week, the snow, along with the NASDAQ in general, rolled over. Snow didn't do all that bad. It's definitely trying to hold support at its 10-day moving average line, but the breakout from last Friday certainly failed. The overall pattern hasn't failed yet. This could just be a retest of the neckline and then it moves higher. But for right now, if you are in snow based on last Friday's breakout, you're very close to covering that position, getting out basically. So I just did that as a follow-up for what you would do, basically thinking 2 or 3 steps ahead. So if you saw this pattern, you bought the breakout, great. What happens if, not that you're wrong, but if the market goes against you? When will you get out? So if you're risk averse, maybe you get out if it closes below the 10-day moving average. If you want to let it play out a little bit more, maybe you get out when it closes below the 50-day. For sure, you're getting out. Well, for absolutely sure, you're getting out if it closes below that low right there. But that's a pretty big percentage moves. So as you could expect, I would be out if it closed below the 50-day moving average line. On the positive side, while last week it did take out all of Friday's breakout, it did it on every day volume got lower. So it seems to be consolidating there and not collapsing off the breakout. So that's a good indication. So
Yeah,
again, this has nothing to do with snow. It's just an example of how to apply technical analysis to chart patterns.
It has nothing to do with TSP.
And nothing to do with TSP.
And people ask us why, we've gotten a few kind of random comments about, why talk about things outside of the TSP? Well, again, remember what we're trying to do here is educate. So a lot of times you just kind of look at the same charts over and over again because we're only looking at CS and I. This allows us to kind of show what these things look like in a different context, and sometimes that helps people learn. It does me anyway, because you can teach different aspects because you Jerry will be able to pull up a different chart and give us a different view.
Right.
So
right,
that's what the bonus charts are for, and it's just something to break up the monotony of talking about
kind
TSP.
Of monotony of TSP.
Yeah. Right. Yeah. It's not the most exciting topic, but it is important because it's our retirement.
Yep, absolutely. Okay. One other thing I just kind of saw here, so I may as well point it out a little bit. If you're looking at Elliott wave patterns, 1, A, B, C is 2, 3, 4, 5. So 1, A, B, C is 2. The breakout is here. Ideally, this would have been 1, A, B, C is 2, and then 1, 2, 3, 4, 5. That's what you're hoping for if you're buying that breakout. That's not what we got, not yet anyway. Okay. So now, yes, to the not so exciting stuff. C-Fund SPX.
It's still exciting. It's exciting.
Yeah, it's exciting if you're a TSP nerd like we are. C-Fund SPX. S-Fund is the Dow Jones Total Completion Index. It is not the Dow Jones Industrial Average. I-Fund, EFA, F-Fund, AGG. Okay. Again, we're doing the 18-month daily charts. Like we said last week, there's no reason as of last week, which was here, to be out of the C fund. On a weekly chart, there's still no reason to be out of the C fund. It was down almost 1% for the week. It's still above the 10-week moving average line, right? That red line. It's way above the 50-week moving average line. We pointed this out last week as the only concern last week was that we got 3 consecutive weeks where we got higher prices and lower volume. And so this week we have a down week and volume was higher than the week before, which is definitely a negative. You got RSI that just ticked below 80. MACD hasn't really turned yet. The histogram is negative, but it's not, momentum hasn't turned sharply negative, and the slow stochastic is still above 80 on a weekly basis. So if you only are trading TSP weekly, the turn has not yet happened. So if you're only looking at it weekly, there's no reason to be out of it. S fund is a different story. Technical indicators are all clearly trending down. We've been in this channel on the S fund here since the top in February, and we had an attempt to break out of it a couple of weeks ago, and the attempt failed and price rolled back over into the trading range. We got this week's close below, pretty well below the 10-week moving average line. So we're right back into the middle of the trading range. At this point, there's no reason to be in the S fund, or no reason to buy the S fund, no reason to really sell it if you're in it, right? I would sell it. Actually, I talk about this quite a bit in the newsletter, so definitely read the newsletter when it comes out this afternoon. But you got the channel here. On a weekly basis, if you get below this channel, you get a big problem. If you get above the channel, then we're off to the races again. But right now, if you're in the S fund and you're only trading TSP weekly, that's where you are. You're right in the middle of the channel that we've been in since February. I fund, we haven't seen this kind of price action in the I fund since kind of back here somewhere. Doesn't mean we're going to get a total collapse. Obviously, back here, when the I fund closed below its 10-week, it was down there for 1 week and then exploded right back up. And the next week gapped up higher. So just because the I fund is closed pretty significantly below its 10-week moving average, doesn't mean it doesn't mean the I fund's doing like this. Having said that, on the positive side, you get pretty low volume on the decline this week. On the other hand, the RSI has definitely rolled over. The MACD turned negative. The histogram is definitely continuing negative, and slow stochastic absolutely trending down. So again, we kind of saw some similar things back here on the lead up to this week, and it moved higher from that. So, this is not the end of the world necessarily, but it's a red flag. It's definitely a red flag on a weekly basis. So on a daily basis, it's worse, obviously. F fund, again, was the only positive fund for the week. And actually, it was really, really constructive because last week we had a negative reversal. We finished above the 50-week moving average line, which is great. But we had a bit of a reversal. So we finished the week almost at the lows for the week. So while we did get support above the 50-week moving average, because we're already above the 10-week, right? The red line's the 10-week. We're already above that. So we got to close above the 50-week here. This week, we maintained support at the 50-week and closed at the top end of the weekly trading range. So it's a much better setup than last week. We got the technical indicators all still going higher. No reason, if you're in the F fund, no reason to sell it on a weekly basis. No reason to sell it. If you're going to buy it, it's not really a bad time to buy it on a weekly basis. I mean, you're looking at support above that 50-week moving average, and so you could buy it based on that and then sell it if it broke below it. The channel is pretty good. So yeah, the F fund is a good place to be while the stock funds are trying to sort themselves out. Last week we also kind of talked about why. So the TNX, $TNX, is the chart of the 10-year Treasury bonds. So when the yield goes up, the price of bonds goes down and vice versa, which is why this sort of looks like a mirror. So this is the AGG, which is our F fund, and which is price. And this is a chart of yield, which moves in the opposite direction from price. So this sort of channel in here, all the way along. The reason I built it like that is because you got support right there, and right here. So that's the top channel line. The bottom channel line is all the support in here, and there, and there. So if you're within the channel, you're kind of in a holding pattern. If you're down here, if price of or yield continues to go down, then price of the F fund continues to go up. So as long as this channel holds for us, and it looks like it is, because it looks like yield hit a high here and is continuing lower. If yield continues down, price of the F fund continues higher. It's pretty much that simple. And 10-year Treasury yields are directly tied to interest rates. So while not interest rates, inflation rates. So it is interest rates, but it's inflation. So as you keep hearing in the media about how inflation is increasing, the big thing you're hearing now is that inflation is transitory. It's not systemic. It's not going to be permanent. It's going to be the cost of rental cars and used cars and housing has had an effect on inflation, but the Fed thinks it's not a permanent inflation, and the market is kind of, I guess, agreeing, because yields coming down and prices continuing to go higher. So that's what we'll watch. Okay.
Questions? All right. Stop sharing that screen so we can see your smiling face.
Oh, that's right. That's right.
Yeah, we're going to bring back the kind of multiple cameras. We're working on that now, so we can see you now, Jerry. Okay. So give us some feedback on what you guys think with this kind of new setup. I mean, sometimes it's just unavoidable. Sometimes we're in different places in the country or the world, and it is what it is, and we have to kind of do it remote like this. But give us some feedback. Is it better, worse, indifferent? Is it, hey, I don't really care about seeing you guys anyway. I just want to hear about what's going on in the TSP, and that's fine. That's really why we do it. But we also want it to be enjoyable to watch and listen. So we put a little work and effort in trying to, kind of build the show to make it at least somewhat bearable to talk about the TSP. Since we are pretty much the only show that I know of, at least, that does take the time each week to break down the thrift savings plan and all the wonderful things in it. Is that all you got for us this week, Jerry?
That's it. I think we put out a lot of information. Actually, this week we had the members only webinar.
Oh, yeah. Yeah, if you guys didn't catch it, if you're members of the site, make sure you go check that out. It'll be on the bottom of the member dashboard. We put the replay down there so you can watch it.
Yep, we got that and the newsletter that'll be coming out and I really try not to cover the same things in all different sort of venues for the weekend.
Yeah.
When we have these once a month where we have the members only call, also it gets hard because we get 3 different kind of big
Yeah,
content
Jerry's all
pieces
over
that
the
we're putting
place
out.
the weeks that we do all those.
Yeah, they're busy weekends for me, but that's fine.
All right, well, we'll take it out of here. You guys have a great weekend, great week coming up. And again, share this with your friends if you get something useful out of it, and give us some feedback. Let us know what you think. Take it easy, guys.
Awesome. Have a great week.